Good morning, everyone. I hope you're all well. Very warm welcome from a crisp but beautifully bright and sunny morning here in Glasgow. Welcome to our panelists and our guests who are joining us from all over the world today. My name is Meeta Samani. I'm the head of the Private Sector Department in the Foreign, Commonwealth and Development Office. And I'm really pleased to be here this morning to kick off Finance Day at COP26 with this Mobilist breakfast event. At the very heart of discussions throughout today at COP is our collective global ambition to mobilize the growing supply of green finance into developing countries at scale, in support of country climate plans to adapt to the devastating impacts of climate change and to finance low-carbon transitions. And in the UK, we are so proud of MOBILIST, which is a flagship UK program to mobilize large-scale investment into publicly listed markets. Earlier this year, Mobilist launched its first competition, inviting the private sector to identify innovative product proposals to mobilize investment into sustainable infra in emerging and developing countries. And we had an incredibly overwhelming response with over 30 applicants. And today we have joining us on our panel 5 of these competition finalists with us. They will be sharing their journey that has brought them to this point and their vision for the products and the vehicles that can scale climate finance across emerging and developing markets. So we have a packed hour for you today. I'm very excited to have this esteemed panel with us. Before we start off, I want to introduce now a very short introduction by our UK Minister for Africa, Victoria Ford, who couldn't be with us this morning, but is joining by video.
Good morning, everyone. It's a pleasure to join you today during COP26 Finance Day. The fact that so many world leaders are here in Glasgow at COP26 sends a clear message. Climate change is one of the greatest challenges of our age. And now is the moment for global solidarity and collective action. At the G7 summit in Carbis Bay this summer, and again here in Glasgow, leaders will affirm their commitment to act. A vital part of this is delivering a step change in our approach to infrastructure financing, strengthening partnerships with developing countries to helping them meet their needs. And it will take a huge financial push to develop the infrastructure needed to transition to a greener and more climate resilient economy. Action from governments is crucial. But we also need private finance to fund technology and innovation and to help turn the billions of public money into trillions of total climate investment. And here, there is a greater role for public listed markets to play with their deep pools of capital. And that is why in February, the UK government invited private sector to participate in our MOBILIST competition. This is to help drive investment in sustainable infrastructure in developing countries. A critical aspect of this is mobilising the private sector to invest in infrastructure in emerging and frontier markets. We ask financial institutions to help us in the search for the best proposals that have potential to list on the London Stock Exchange, or indeed on local exchanges across the developing world. And we back the competition with public capital, with technical assistance, and with support from our network of diplomatic missions around the world. And I'm delighted to tell you today that we have 5 finalists in the competition who you will hear from later. They will support the private sector to access climate finance more easily from new sources and at scale. Together, they will drive innovation in capital markets that will deliver at scale the new investment needed in developing countries over the next 5 years. And this will help to build reliable infrastructure, including renewable energy sources, boost climate adaptation efforts, and drive jobs and economic growth. And we are supportive of all 5 proposals. By supporting the development of a public market financing model, the longer-term potential is significant. I want to recognise the very many institutions who participated in this competition, some of whom are with us today. And on behalf of the UK government, my sincere thanks for sharing your ideas with us. You saw the opportunity that public markets present, and we heard you. We trust that these relationships can continue this journey together through the Mobilist programme. The programme is here for the long term, with plans to run new competitions backed with our equity capital and technical assistance. And together we can fund much needed private financing into developing countries to build high quality infrastructure and boost prosperity. Together we can help change the landscape for development and climate financing and play our full part in meeting the defining challenge of our age. And you will hear more from the Chancellor on UK support later in the day. Thank you.
Brilliant. Clear message from Minister Ford on the UK's ambition for the mobilisation agenda and the role of Mobilist within that as well. So before we turn to the main event today, where we'll hear from our esteemed panel, I just want to spend a few minutes just setting out the wider context as we see it in FCDO, in which Mobilist programme sits. I mean, the first slide that you'll see on your screen is a familiar one to many of us. You know, let's start off with some familiar numbers on the problem we're trying to address, which is the significant climate finance gap. These numbers here show a story of increasing need. The financing gap to fund the SDGs was already large, and then the pandemic has increased this gap by an estimated 1.7 trillion to now sit at around 4 trillion annually. That's substantial. And 2020 marked the first increase in global extreme poverty, reversing 2 decades of progress. So to support just transition in emerging and developing countries and achieve 1.5-degree target requires over $1 trillion of investment in clean energy alone by 2030. Without that, energy-related emissions from these countries will grow by 5 billion tons over the next 2 decades, and 750 million people still lack access to electricity. The financing need, of course, is not just to mitigate emissions, but for so many people around the world, in particular the vulnerable, it's about adapting to the devastating impacts of climate change and building their resilience to so much more impact that's coming. And beneath all these kind of trillions and these headline numbers, there are countless stories of lives being affected by droughts and floods and food shortages, and so much potential that's being held back by lack of access to energy. So public finance is, of course, important. It's critical. It will continue to be critical, and it plays quite a unique role in the international architecture. But it's not enough. And we heard from Victoria Ford, it's not enough. We need to support developing countries to access the growing supply of private green finance. There's a lot of innovative and blended finance solutions out there in the market that are helping, but most of these transactions are in the private markets and are not accessing the vast potential that's there in public markets. Would you go to the next slide, please? Right. The 4 trillion financing gap here represents only a tiny fraction of more than 80 trillion assets under management by large-scale institutional investors, many of whom have joined us this morning. Most of this is held in OECD countries where assets are highly correlated, yields are low. Only 4% of global pension fund assets are invested in emerging and developing countries. There's a huge opportunity here now in emerging and developing markets. So standards and regulations are maturing and innovative products are beginning to come to market. Clean energy equities have consistently outperformed the MSCI Emerging Markets Index. And investing in these markets offers institutional investors improved yields and diversification benefits and impact. Opportunity is there. Can we go to the next slide, please? I won't go through this in too much detail, but just to say, while there is a huge amount of opportunity, there's also huge barriers to mobilization. We're not naive to that, not least the lack of diversified assets, the high and perceived high risk, macro high risk, the lack of listed products, the information asymmetries, and the list goes on. And addressing these are a strategic priority for our international work in FCDO. with our bilateral program, but also really working closely with our partners in the MDBs, CDC, the UK Development Finance Institution, PIDGE, and across the private sector. We work to tackle the spectrum of barriers to private investment, from improving the policy and regulatory environments to generating pipelines for investable projects, to creating the financing structures needed to mobilize investment at scale. And yesterday, many of you will have heard the Prime Minister announced a package of support for investing in sustainable infrastructure, which is set out here in the slide. I won't repeat this. It's all available on multiple media sites, but we're very happy in FCDO to answer and speak about this package that we proudly launched yesterday. Next slide, please. So to really come to the heart of the discussion today, Mobilist. As I said earlier, so far, a lot of our interventions has mainly been in the private markets. Mobilist is our innovation in the UK offer that addresses this specific public markets gap. It's a hugely exciting partnership with the City of London to kickstart listed products for infrastructure investments in developing countries. It sets a stage for a major scale up in getting trillions of investment where it needs to go to support climate transition and adaptation. We have major ambitions to work with so many of you here in the audience, including and our panelists. The impetus for Mobilist is that we know institutional investors prefer to invest in listed products because it allows them to achieve the scale they need, access investment-grade diversification, and reduce the costs of due diligence. So Mobilist is set up, as you see, in two platforms. We have a product platform, which will source proposals from the market through a competitive process and provide investment managers with technical assistance, with seed capital, and with any necessary support to list sustainable finance products on the London Stock Exchange and other stock exchanges around the world, including in developing countries. And the second platform is a research and policy platform, which supports the wider ecosystem by closing data gaps, promoting, enabling policies, and building market awareness to make Mobilist products a success in the market. Next slide, please. As Minister Ford set out, the first competition was launched in February. It was a search for the most innovative financial products that could be listed to mobilize capital for sustainable infrastructure. Overwhelmingly, 31 proposals demonstrated that the appetite the market has to engage with this program. And across these proposals, there were really high quality, innovative ideas. These proposals were then assessed through a thorough competitive process with thorough analysis to ensure that they met 5 core principles of Mobilist, which are commercial viability, replicability, the ability to scale, additionality, and feasibility. And we've now narrowed down the field, and it was a painful process to do that, to 5 finalists who are now in commercial negotiations with the FCDO. These finalists are here today. They've been through an extensive due diligence process with us since February. They have demonstrated their strong credibility and their potential for innovation and impact. Next slide, please. And I'm really honored today to introduce them. So we have with us today Nick Collar from First Rand Bank Limited and David Jackson from UN Capital Development Fund. We have Phil Southwell from Chapel Hill Denham. We have Babatunde Soyoye from Helios Investment Partners. We have Las Pereira from Green Guarantee Company. And we have Nandita Tuli-Sagal from Thomas Lloyd Group. They are our esteemed panels today. And to take us through the panel discussion, I want to pass over to Ross Ferguson. Ross is the Senior Private Sector Advisor in FCDO and really is the architect of the Mobilist program. So I'm very pleased to have all of you here today, and I'll pass over to Ross.
Morning. I hope everyone can hear me. Apologies for that technical interruption. Hopefully we can move forward. The important thing this morning is to hear from the participants that Mita has just interviewed. So rather than taking any more time speaking, I'm going to go straight to the first of our excellent 5 competition finalists. And I must say it's been a pleasure to work with all five through this competition over the last months, since February. I do know that very many in the audience have been also part of the competition. I want to express my sincere thanks for the terrific engagement we've really had from the wider market. And here we have our five finalists today. So without further ado, Babatunde Soye, Managing Partner, Founder of Helios Investment Partners, and in partnership with Infraco, which is part of the Pidge Group, a multilateral development bank, which I know that many of you will be familiar with. Babatunde, if I may put the first question to you. The Clear Fund, which is the proposition which is part of the competition, is a collaboration with Infraco Africa, and for Helios, which is widely known for its private equity and its lending business. This is a new evolution for you. The expectation, I think, is that we move to a situation where the Clear Fund can eventually list on the London Stock Exchange. Would you like to say a bit more about the proposition?
Morning, everyone. Thank you very much, Ross. Got to say, actually, unfortunately, I'm not in Glasgow with you, but my partner in this project, Gilles Weiss, who's the CEO of Infraco Africa, is there. And ideally, it would have been great to have him on the screen with me, but it's technically not possible. So just to give some context, the context is always useful when actually one thinks about things. So Africa today, if you look at the world today, the problem everyone is trying to solve is one of mitigation. So there's a lot of carbon emissions out there and methane emissions that the world is focused on just trying to deal with today's problem and not actually thinking ahead of tomorrow's issue. Now, what's great about the Mobilist competition, I think, actually, which I think is what we're thinking about Africa, is that with the Africa's demographics, with a very young population, a massive infrastructure gap that exists today, which is actually still growing, yes, and the demographics of a very young population, actually, if we don't get ahead of the issue of getting ahead of actually helping Africa leapfrog, investing in old school carbon emitting infrastructure, Africa would actually become a material contributor in the future to carbon emissions. So it's really, yes, it's important to deal with today's problems and issues of just how much all the carbon out there is critical, but we need to also deal and get ahead of tomorrow's problems and issues. And Mobilist is actually looking to solve this in a very, very clever way. Now, so then one looks actually, okay, how does one solve that problem? And one looks across Africa. I think the biggest challenge has been, I would say, around the whole developer, the whole developer ecosystem. So there's not, the demand is large, the opportunity is huge, but basically innovation in basically financing, innovation in product, innovation in business model, innovation in regulation, overlaid with having best-in-class ability to help developers basically develop their projects, plus having security of some sort in offtake of their projects when the projects are completed, I think is absolutely critical. And doing all of this at scale, because scale is important. Investors around the world only come into things when they scale. There are many of the organizations out there who sign big checks commercially. If you've got scale, they don't get out of bed for less than $100 million, say, for example. So to actually attract them, you need to have scale in your product. So doing small scale products is not going to attract big investments. So we've got to think really, really big to attract the big capital that's required to solve the problem. So in putting all of that together, we've worked for probably about a year now. We've known Infraco for a long time, but we've worked for about a year now with Infraco in trying to create a product that we think meets and satisfies all of those issues, which is basically addressing the developer ecosystem and creating innovation in finance, innovation in products, innovation in business model, as well as innovation in regulation to help create a business called the Clear Fund that would enable and attract investment at scale. And we've done that by marrying Helios. Helios has been in this business for nearly 20 years in Africa. We've done some renewable type infrastructure, what you call soft distributed infrastructure type businesses. But Infraco Africa has been at the heart of the whole developer development and ecosystem in Africa for decades. So marrying those two together and our track record in innovation, even this joint venture is an innovation in itself, of us combining ourselves together, is an innovation of itself. Along with Infraco's asset management expertise, because working and creating value in Africa is not just a pure financial play where you sign a check and hope for the best. You got to get actively involved in value add in the businesses which you operate in, to make sure you can help resolve and deal with day-to-day issues. And Helios, we have a group called the Operations Group, which actually is half of our firm, who are just operational people with CEO, CFO experience, operational experience, strategic consultant experience to help drive value creation in the businesses we get involved with. And Infraco has something similar on their side, which are called Asset Management Group. So I think all the assets, we just did all the work, put all the pieces of the jigsaw together, and now we have something which I think is leading and world-class to be able to sort of help at scale develop the developer ecosystem while creating impact and climate mitigation and climate adaptation products at scale in Africa to help contribute to Africa not being a producer or contributor to the emission problems in the future. I don't know if I've answered your question, Ross.
Babatunde, that was terrific. Thanks very much. We're so looking forward to working with Helios and Infraco to realize this ambition in the coming months. And thanks so much for joining us from Lagos, and I could see the technology work perfectly there. Without further ado, I'm going to turn to our second guest here today, and I'm delighted to welcome Blas Pereira, who is the co-founder of the Green Guarantee Company. And of course, many of you will know that Laz was with Guaranco and was working, Laz, if I can sort of paraphrase, working to solve local currency guarantee issues for a long time. And the Green Guarantee Company is an evolution of that. The focus is on hard currencies. And it's an ambitious and exciting model and an evolution of a lot of the work that you've been doing and your partners have been doing over the last few years. Would you like to tell us a little bit about that vision and the challenges you're seeking to overcome?
Sure, I was happy to. And just to introduce Jo Zuberg and my colleague, Jean-Pierre Sweets, who are also co-founding the Green Guarantee Company with me. Look, it's a very, you touched on the history, right? So why after 12 years of working in local capital markets, trying to develop bond markets in developing countries, am I now looking at hard currency? And the simple answer is that we all know what the climate challenge is, the urgency, and Mita gave us a lot of statistics. So let me give you another one. So I was informed yesterday by my friends at the Climate Bond Initiative that the green bond market globally is now $1.4 trillion. Now, to put that into context, 15 years ago, it was $150 million. So actually, that's been a pretty exponential rate of growth over a short period of time. But again, to give more context, of that 1.4 trillion, less than 3 billion cumulatively has been issued out of Africa, for example. And if you go broader, the emerging market and exclude China, then the emerging market global issuance of green bonds is still very low single-digit percentages. So everyone knows there's a big climate finance gap. How do we address it? Well, we need to get more of that growing green bond market going into developing countries. And one of the things that I learned during my time over the last decade working with local institutional investors is that the guarantee product can help give them the confidence they need to take risks that they previously wouldn't have been able to take by themselves. The analogy I like to use is one of the airbag in a car, right? Nobody ever wants to use their airbag, but it gives them confidence to know that it's there just in case. And that's what the guarantee will do for, hopefully, for global investors looking to now come and participate and help grow the green bond market in developing countries. And we don't just want to stop there, because having sort of issued these guarantees, we still see another way of bringing in the private sector, the global capital markets, and that's through the insurance markets. And we're working with BPL Global, one of our partners, to basically arrange a program where, having provided these guarantees to global investors on bonds, we're then able to go to the insurance market and share some of that risk that we're taking as the green guarantee company with them as well, and thereby do more with the capital that we have. But also to bring and create more understanding and address the information asymmetry that exists at the moment. The perceived risk is always worse than the actual risk when it comes to developing markets. And what we want to do with the guarantee is basically close that gap, that perception gap, and bring everyone closer together. And the idea will be that over time, once investors have been investing with the guarantee, they will start to appreciate these risks a bit better, and then eventually say, we don't need this guarantee. And Ross, there's precedent for this, right? If you look at the municipal bond market in the US, in the early 60s and 70s, a guarantee industry sprung up, the monoline insurers. And that market is now in the trillions, but those insurers have largely disappeared because there's no need for them. Largely, global investors in that market now are very happy to provide those trillions without any credit enhancement. It's the same in the mortgage market. There are a lot of mortgage refinance companies in developed countries, but we're not thinking about credit enhancement for developing countries and on the global scale. And this is really what the Green Guarantee Company has been set up to do. And hopefully, with the support of Mobilist and others, we are going to try and be operational next year and start getting more green bonds from the emerging markets out onto stock exchanges like the London Stock Exchange and others, and to bring and crowd in that private capital that we're all looking for.
Great, Laz. Terrific to hear from you, and terrific to see the members of the wider team with you today. And again, we look forward to supporting you on this journey. And I know there's a lot of other partners that are interested in supporting the Green Guarantee Company, and that's terrific to see. I'm going to turn now to our third distinguished guest, and I'm going to come to Nandita at Thomas Lloyd Group. Nandita is Managing Director of Infrastructure there, and as part of the team that we at Mobilist have been working with for many months. And Nandita, I have to say, right from the beginning of our discussions in this conversation, it was clear that Thomas Lloyd Group had a clear vision for what they wanted to do, and dare I say, a timetable for doing that. And this is renewable energy. It's in developing Asia, and you have plans, I think, great plans for the near future. So I'd be grateful if you could tell us all a little bit about those plans, the importance of the geographies, and the importance of public markets for Thomas Lloyd Group.
Thank you, Ross. I'm delighted to be here in Glasgow, in sunny Glasgow, and honoured to be representing Thomas Lloyd in today's discussion. So as you rightly say, Ross, to achieve the net zero in 2050, we need to tackle the challenges where they are most needed. And in our opinion, this needs to be done in high growth and emerging economies in Asia. The main reason is that Asia's 4.6 billion people account for over half the world's energy consumption, but 85% of that comes from fossil fuels. So population growth, economic growth, and the rapid urbanization are driving this rapid increase in the demand for energy. Now, carbon emissions in Asia are now greater than Europe and North America combined. And despite these developing markets accounting for the majority of global CO2 emissions, they only receive about 20% of clean energy investment globally, And this is the issue that we're really trying to address with our proposal. There's a clear and very urgent need for large-scale investment into sustainable energy in the highest emitting countries in Asia. And I guess we all agree here that the time for talk is over. We now need to mobilize and deploy capital in listed products that can deliver investors with attractive returns, but also, more importantly, having a positive and real impact on improving the environment and reducing these emissions. The other benefit of investing in these markets, and Mita mentioned this earlier, is the social outcome of creating the direct and the indirect jobs for local communities. At Thomas Lloyd, we've been investing in renewable energy in Asia for a decade now, and we believe that that's where our capital creates the greatest impact. We've deployed over $1 billion across 16 projects in power generation, transmission, and sustainable fuel production. And we've built a capacity in excess of 700 megawatts. And that makes us one of the longest established and most experienced investors in the region. In our opinion, a natural fit for the FCDO's initiative and a strong potential partner to support the UK government's climate and investment agenda. Since 2013, the other things we've been doing is measuring and reporting on the impact of our investments. And this is across a range of metrics, including employment data, CO2 offset, water usage, health and safety, and gender ratios. Currently, we have a portfolio of renewable energy assets across India and the Philippines. And a very good example of the resilience of our portfolio is that during the midst of the global pandemic, we successfully constructed our largest solar power plant to date. It was in Uttar Pradesh in India and is a 75 megawatt utility scale solar plant. This new solar energy plant provides clean and renewable energy to more than 109,000 people in northern India. It reduces 41,000 tons of CO2, and it created 900 direct jobs during the construction phase, but also has a significant multiplier effect on the local community. And using this same proven strategy, we're now very excited to be launching the Thomas Lloyd Energy Impact Trust, the first emerging markets renewable energy product to list on the premium segment of the London Stock Exchange. And it will invest exclusively in a diversified portfolio of unlisted sustainable energy infrastructure in Asia. We're targeting an initial fundraise of $340 million in assets that make a real difference to achieving net zero, alongside delivering the financial returns and providing shareholders with attractive dividend income and long-term capital appreciation. We ourselves are anchoring the fund with a portfolio of seed assets, which comprise 10 projects across India and the Philippines, totaling just over 0.5 gigawatt. And further to that, we plan to scale up and replicate this strategy in both India and the Philippines, but also in neighboring markets of Vietnam, Indonesia, Bangladesh, and Sri Lanka. We have local expertise in these markets, and we intend to develop using the same proven approach that we've done for the last 10 years, working with our long-term local development partners, and that allows efficient deployment of capital. That's our key differentiator, and that's what we believe at Thomas Lloyd. We're really very proud that that our investment activities contribute directly to the reduction of carbon emission and the acceleration of the transition to renewable and clean forms of energies in the markets that we operate. I think we all agree we need to work together to mobilize large-scale institutional investment in Asia at pace. I guess my final point is I'd really like to thank you, Ross, and the entire team at the FCDO, and on behalf of Thomas Lloyd, thank the UK government for their global leadership to this critical challenge that impacts all. Also like to really wish all the other participants very good luck and look forward to working with them in the future. Thank you. Back to you, Ross.
Thanks, Nandita, for your kind words. I mean, this really is an exciting and immediate story, and we're with you all the way. We're wishing Thomas Lloyd good luck And we recognise too that this is a significant innovation on the premium segment of the London Stock Exchange, and I'm sure we'll be very interested to see how this moves forward in the next few weeks. I'm going to turn to our fourth set of panelists here, and I'm delighted to introduce Nick Collive, Senior Principal at First Rand, one of the largest banks by market capitalization in Africa, if not the largest. Nick will be able to remind us. And also David Jackson, who is a director at the UN Capital Development Fund over from New York. Nick and David, this is probably the largest team that we as a competition have participated with. Two large organizations, lots of working parts in this. And it's been a pleasure to work with you over the last few months. This is perhaps, if I may say, the ellipsis model is perhaps not the easiest model to understand, unlike maybe an energy investment trust. It's a central market counterparty vehicle. It allows, through working with commercial banks, with DFIs and MDBs, the opportunity to securitize assets, co-lending, and thereby provide that part of the financial architecture which arguably is missing in some parts of the world. This is also a very interesting collaboration between yourselves. Could you tell us a little bit about the vision for Ellipsis, UNCDF's role, David, in that, and how you're working together on this proposition?
Thank you very much, Ross. We're very happy to be here and would like to thank the UK government for launching the Mobilist program, of which the Mobilist competition is one part. We'd also like to thank PwC for managing the process and also for their hospitality. Ellipsis is a very creative vehicle indeed, and as you mentioned, it's not very easy to sort of put together. Operationalizing it is not trivial, but we have made tremendous progress, and I think that our two institutions are very well placed to bring Ellipsis to fruition. As you described, the overall idea sounds pretty straightforward. We want to use traditional synthetic securitization in order to share through listed securities exposures in sub-Saharan Africa with institutional investors. So the model seems very straightforward, but it is actually the steps within the model that are sort of very tricky. In particular, what we're looking to do is we'd like to increase financing in the LDCs by basically combining, creating non-homogeneous portfolios that include LDC exposure, LIC exposure, LMIC exposure, and UMIC exposure. So this is very largely the creativity within this model. We basically recognize that if we wanted to focus on LDCs alone, there would be not sufficient progress. But if we were actually to combine LDC exposure with, say, UMIC exposure, then by doing a lot of transactions, the end results would actually have a greater development impact. So as you sort of mentioned, First Rand is a large bank. It is in fact the largest in terms of market capitalization in Africa. We do have a lot of market expertise. We are also a very responsible institution. We have instituted shared value principles. We produce an annual report to society. We have put in place now DFI strategy, but we still need certain partners, right? And in the spirit of the SDGs, we sort of take partnerships very seriously. And as you can see in this case, we have created this very special partnership with UNCDF. We're uniquely placed to bring Ellipsis to fruition. UNCDF, as David will point out, is very much focused on the world's LDCs. The vast majority of those are in sub-Saharan Africa. And of course, they also bring certain standards to bear. We basically look to UNCDF to produce the filtering, monitoring, and reporting tool because we're extremely concerned about greenwashing. So I think that the model and this partnership have tremendous potential. We believe that once put in place, everyone would see the tremendous development impact.
Indeed. Indeed, and I'd like to return to the earlier point about perception. So if it's perceived to be quite complicated, but we believe it is doable, but also absolutely necessary. If you look at Africa, it's becoming an urban continent. It took Paris 100 years to go from 500,000 to 1 million people. Lagos did it in 15 years. Other countries are now doing it in 10 years. The demand is there for clean transport, clean energy, water management, which is a large 70% of adaptation is water-based, waste to energy. The green infrastructure demand in African least developed countries and lower middle income countries is huge. It's demand for debt financing, and the balance sheets of banks are not able to meet that demand right now. By securitizing mature assets through the model that Nick has mentioned, it frees up the space in the balance sheets of those banks to invest in the necessary infrastructure for the green, productive, and urban transition that Africa is going through. Without something like this, you're going to see unsustainable cities that are going to fuel migration. They're going to be environmentally unsustainable, and as we're hearing at COP, they're going to be unlivable. They're going to be unlivable. This is the type of vehicle that frees up the capital to prevent that from happening. Now, the filters that we will design will make sure that all of the infrastructure, both the securitized and what the freed up balance sheet will be deployed to, will meet the NDs, will meet in a measurable way the country's contribution to the Paris Agreement through their nationally determined contributions and their national adaptation plans. So that is the filter and the reporting and the monitoring that we will provide, which will provide security to the investors that that's what they will be contributing to. And this is really part of the financial ecosystem that needs to be created. We've already heard about the guarantee. That's a key part of the picture. This securitization will free up balance sheets of commercial banks and DFIs in Africa, including national DFIs, Ugandan Development Bank, Tanzania Investment Bank, etc. It's all the ecosystem that needs to be built. And I think the final point I'd like to make to Nick's earlier opening comments about the pooling, we learned this through the International Municipal Investment Fund, which was another one of our initiatives, that by creating a sister fund which invests in OECD countries, you're able to pool assets, pool investors, I should say, pool investors, because the lower middle income countries, a smaller portion of the total pie, they come in with confidence, and that gives them more than if the fund was exclusively dedicated to them. So that's the principle. And we intend to increase the proportion of the securitized assets that are derived from the lower middle income countries and the LDCs along the life of the Ellipsis vehicle, which will be floated in 3 years' time through an IPO following this incubation period, for which we're very grateful to FCDO for putting forward the opportunity to get the thing kickstarted. So we're very, very excited. This is a key part of the transition of the LDCs, so they graduate from that status and become on sustainable growth paths, not simply graduating statistically, but still remaining on unsustainable paths. Thank you.
David, thanks, and Nick. I mean, that's an important final point, David. Not only is the Ellipsis platform the proposal that it generates securities that can be listed, but the platform itself can list over time. So that's great to hear. Thanks very much. Look, before we turn to our final guest today, Phil Southwell, who's a partner at Chapel Hill Denham, I just wanted to mention that I think the intention is to put some slides, participant slides, on the Mobilist website after this call this morning. So there'll be an opportunity for you to have a look at those in more detail. And also to say I'm extremely grateful for the questions which are coming through on the chat. The audience will already understand that my ability to manage technology is very limited. But Phil, I mean, there is one question in here, which just one of many, which is around attracting pension funds. Now, Chapel Hill Denham, you've come in from Lagos over the weekend. You're based there. This is a company which is very firmly based in Africa, in sub-Saharan Africa. and the Nigeria Infrastructure Debt Fund, I think, was the first listed fund in Naira on infrastructure debt to be achieved in sub-Saharan Africa. So maybe you can address the question of pension funds and how you attract them, particularly in terms of the proposals that you're discussing with us through the competition.
Thank you, Ross, and thank you, Ross. Thank you, Mita and FCDO for the Mobilist process. My partner Balaji Balogun and myself at Chapel Hill Denham, sitting in Lagos and in our other offices in Africa, face this challenge every day, and that challenge really is finding a way to attract some of the institutional capital that exists globally to address some of the issues that exist across Africa. And I guess the scale of the challenge is obviously very large across the continent, but the scale of the challenge is very small in terms of what proportion of global assets under management we need to attract to make a really, really significant difference across the continent. Data has shown that substantially less than 1% of the capital managed by global institutional asset managers can completely change the economic and social history of Africa and help the continent to feed the world, resource the world, and to reverse the current migration. But at the core of that is infrastructure. And we think that, in order to channel institutional capital into infrastructure, we need to channel that primarily into the long-term institutional asset classes. So we're really focused on infrastructure debt, and we're focused on operational infrastructure equity as asset classes rather than in development products. And we see most of the competitive funds and activity across the continent primarily focused around development assets. We think institutions like operating equity and infrastructure debt because they generate long-term predictable revenue streams, and we're able to transfer those revenues through dividends back to those investors. And Africa can deliver, really very, very substantial dollar dividends to investors. And what our plan is to take this tried and tested model of a UK investment trust and just apply it to a different market, which is Africa. All of the characteristics of the infrastructure asset class to an extent remain the same. Infrastructure continues to deliver very high risk-adjusted returns for investors. And I think what we found is that, by already taking this tried and tested route and applying it to infrastructure debt in the continent, we've demonstrated with 100% returns over 4 years that this can deliver a very, very good return for investors. But what investors need is diversification. The investors certainly that we speak to are less interested in single risk greenfield projects and more interested in large diversified portfolios. And that's what the Mobilist program and that's what a listed investment trust in London is able to achieve. Sort of final comment really from Balaji and myself, which is that we found that COVID has taught us many lessons. And to an extent, we've been very lucky in COVID because actually our entire operating team are based in the continent and the operating team of our subsidiaries also are based on the continent. And we found that having an asset manager based on the ground without any of the travel issues that have severely affected our ability to do business has been a real game changer for us and has allowed us to grow the business substantially during that period of time. Thank you, Ross.
And thanks to you, Phil, for those words. You and I, we have talked for a long time over the last few years about the opportunity and the opportunity of public markets. And thank you for addressing the issue of investors. And I just want to spend the last few minutes just to put this question back to our panelists for just a wider comment in terms of what have investors being saying to you that they want to see in terms of your product when you're structuring it. And obviously there are different types of investors and different risk appetites in there. And if I could just ask who, we could maybe go round, and Babatunde, if I just go to you very quickly first, who is your investor base in relation to your product? And what are your key messages to those investors? Babatunde, if I could just ask you that quickly. Thank you.
Thank you very much. So I think our product's going to probably have 2 or 3 different phases, and at each phase, the investor base it will be slightly different, because our plan is not to start with the listing. Our plan as it is basically to build up on the private fund initially to have the diversity, which I think Phil mentioned, diversity, to build up to a portfolio of diversified assets at a particular level. And then once you've got a large enough portfolio of diversified assets, to then list the vehicle at that point in time rather than listing beforehand. So we've got 2 different phases to address. And the first one, which is where we are right now, we are also considering the different levels or some levels of innovation in the capital structure of the first phase. There might be investors who, for example, might be willing to take, first loss in the capital structure, who are more of the endowment type investor types. Yeah, there might be impact investors who are basically looking at the impact metrics that one is achieving from what one is doing. There's traditional PE investors who basically, the sovereign wealth funds, the insurance company, the public pension funds, who are basically looking to get people who invest in the normal Helios funds, who are looking for just the returns that we generate, but actually want to see what we're doing on the climate and infrastructure side of things. So it's a diverse group of people, but I think the key thing here, is that we need scale, and to get scale, we need as broad a group of people to be involved. And also the other point is that what we need for Africa, for most of the world, is to have the diversity in number of investors. Means as appetites swing and change, yes, you want to have a business that basically, as one person changes their mind on something, you're not at the whim of just one investor type. So by having a diversified pool of investors from all the different parts of the world, it also protects your business and makes your business robust through the years as people change their mind or decide they want to invest more in OECD versus Africa and so on and so forth. So long-winded answer, first phase, be as broad as possible, private in nature, then get to diversified pool of assets and then list.
And that's the challenge, Babatunde, I guess, to move from one set of investors in a private market setting to a different set of investors in a public market setting. Great. We are running out of time. If I could just ask, I won't put all the participants, all our guests on the spot at the moment, but in terms of that investor base, if I could just ask you to indicate with a raise of the hand. David, I see your hand up, so I will come to you first. Over to you, David.
Thank you so much indeed, Ross. So I think for us, the public market listing is important. We're looking for long-term institutional investors, pension funds, and the others that are able to pick up publicly traded securities that are then backed by these emerging market and LDC assets for which there is a huge demand. So I don't know if Nick wants to add anything, but to us, that's the critical element to this.
Absolutely, yeah. So basically, what we do in ellipses, there are basically two kinds of investors: the securities issued by ellipses, and so there we would rely on foreign and domestic institutional investors, and then of course we will have the investors in ellipses who would also be sort of investors who are interested in investing in vehicles that transact on market-related terms. So we are very much interested in this requirements of the Mobilist competition. So we very much want the project to be bankable. So that's basically our focus.
That's why I mentioned the IPO after 3 years. And the other point is that we're exploring the possibility, and we've discussed this with you, Ross, about the way that ellipses will be listed. Sorry, we've enabled pension funds in LDCs and other emerging markets in Africa to invest with their own resources without having to deal with the exchange rate because they'll be listed in various currencies. That's part of the plan as we discussed. I think that's huge because it opens up domestic savings for this type of investment.
Yeah, absolutely. Absolutely, David. Thanks very much. We're running short of time. Phil, I'm going to give you the last word, and then I'm going to hand back to Mita to thank our audience and our guests. But Phil, back to you for the final word.
Thanks, Ross. I guess my answer to that question is simpler. I think that what public market institutional investors want is a real return. I think they understand these infrastructure asset classes. And so consequently, when they look at continents like Africa, they see that African sovereigns will deliver them 7-8% in dollars, and that an infrastructure equity vehicle will deliver them consistent double-digit returns. I think the opportunity that Mobilist has given has been an opportunity to allow capital to get recycled in Africa. I think it's really hard to get institutions and corporates focusing on investing in the continent if they have no ability to subsequently monetize and sell. And that is what this program and what you, Ross, and Mita have done in terms of delivering through the Mobilist program. Thank you.
Thanks, Phil. Taking over from Ross now. I'm sorry, folks, we're a minute behind schedule, so I will try not to wrap up for too long. But let me just first start by saying to the audience, I hope if you're going to take away 2 words from this panel discussion, I hope it's opportunity and innovation. That you heard from all our panelists today, you heard from Babatunde today, the imperative of working with Africa on mitigation now and not waiting, and the ambition of Helios and Infraco on the launching the first renewable energy platform for Africa. You heard from Laz today, the power of guarantees to stimulate and grow the green bond market in developing countries, and their ambition to share that risk with insurance markets as well. And also that perceived risk is always higher than actual risk. You heard from Nandita today, the opportunities and the needs in Asia, the ambition for their first ever Asian-focused renewable energy fund to be listed on the London Stock Exchange. So huge innovation there. And you heard from Nick today about their innovative, relatively complex vehicle that looks to fill a genuine gap in the market, securitizing sustainable infra assets in Africa and creating that critical exit opportunity for MDBs, DFIs, and other investors, freeing up their capital for more investment across the continent. And finally, you heard from Phil today, taking a tried, tested model from the UK market out and applying it to Africa to give investors their access to what they need, which is large, diversified portfolios. So please join me in thanking so much the panel for joining us today, the morning of Finance Day at COP26. We wish you all the very best in your journey to fulfilling your ambition. We look forward to joining you on that journey. And we hope you and the audience will follow their success. Look forward, everyone, to some announcements today from the Chancellor, as he will talk about the future ambition of Mobilist beyond this competition, in this competition and beyond it. Thank you again to the panel for joining and for your precious time. Thank you to the audience for following us and for joining. And we hope to see you all soon again. Thank you.